For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
All right, welcome back. Another episode. Oh, yes, this is fun stuff. Johnny Dean here, podcast host. I'd say podcast host extraordinaire, but that just, I don't like it when people do that, you know? It'd be nice, Professor Rick Plum, certified financial planner professional and co-host here. It'd be nice if you said that once in a while, but I'm not going to make you. That was your cue to say, gee, you are podcast host extraordinaire. That's
all I know is that there is absolutely no way I could ever do any of this without you on that side of the microphone, because I sure couldn't do this.
Well, it shows what experience can do, because I mean, as much as I know and I've learned about financial planning, and as much as I feel like the knowledge that I have, there's no way that I could do what you do, which is to actually sit in front of somebody. I've never done that, and I don't have the licenses, but I could not sit across the desk from somebody. I'd be way too nervous that I'd do something wrong. And so
it is something that, I mean, it does weigh on our minds when we're, because we take a lot of we take a lot of pride in what we do, but we it's a lot of responsibility.
Absolutely.
And it weighs at times, yes.
No, it does. I mean, a guy like me, I can sit here and have fun and do the podcast, and I pretty much know what I can say and what I can't say, but it's all fairly harmless. But I mean, for somebody who's an advisor like you or any of the folks at Lucia Capital Group, not to start off on a heavy note, but it really is an important responsibility. And I think you've been doing this long enough, Professor Plum, and it takes a lot of experience where you're pretty confident in what it is that you're doing, but you cannot take. It's like an airline pilot. You can't take your eye off the ball. As even if you've made 4,000 flights or this is your first one, you cannot take your eye off the ball. And I think that's true of any financial advisor.
Well, and every strategy, every plan is going to be a little different because the person's a little different. Mm-hmm. And maintaining it, I mean, just like every pilot, every flight is going to be slightly different. There's going to be a little bit different condition, a little this, a little that different. And you have to be able to adjust and go through it and understand how to make it work.
Yeah, and you have to be able to look ahead and say, I'm not going anywhere near that. I've seen this before. I want to avoid this. Oh, look at these metaphors flying. But yes, it's so. Take this back. I think we're both in the right seats. Podcast seat, harmless stuff. You can sit in the advisor's seat and you can do that all you want, and that's what we've been doing for these many years. And I'm happy to have you back on. Let's see. This is 2025. I was trying to think. Let's see. We've been doing this podcast, this actual podcast for 6 years, I think, or this is the 6th year, something like that. So it's just time is creeping away from us. And speaking of time, I don't want to take up too much here, but Professor Plum, this is something that we used to do on the TV portion of our show back when we were doing it, and even on the radio portion of the show. I like to compare the different types of withdrawal methods that are out there and talk about why we always wind up doing buckets, why we do buckets, why we believe in the bucket strategy. And I'm going to call this the bucket strategy, which I started doing this past year, because there are different forms of bucket strategies out there, but so many of them are just not correct. And you know what I'm talking about, but
they try to be everything. So they try to be buckets, but they also try to be systematic withdrawal. They also try to do everything and all in one thing, but it's not quite the same.
No, it isn't the same. So when I talk about the bucket strategy, it's the strategy that we talk about on this particular show and the one that folks at the Lucia Capital Group employ. So I want to go through some of these different withdrawal methods. There are pros and cons, if you want to call that, of each one, but the cons, I think, outweigh all of these others, except for the buckets, and we'll get to that in just a second. But let's talk about these. There are really there will be 4 that we're going to discuss today. The last one being buckets, but the first type of we'll call it an retirement income strategy, a withdrawal strategy, would be one where you have a portfolio and you just live off of interest and dividends. In other words, you don't touch the principal.
Well, one of the ways people talk about that is they're just going to buy bonds. Back when bonds, Grandma used to do this, they would buy bonds and utility stocks that paid very stable income, very stable interest, and it didn't change from year to year. It was the same thing, and so they could put in, they could make 6% on a bond portfolio. And so they lived on the proverbial 4% and left 2% in to grow for the future inflation. And there was very little risk. It was all guaranteed, top rated bonds or treasuries. But the problem is it doesn't always work that way, because as we saw just a few years ago, for about a decade, we had interest rates at or near zero. Mm-hmm. And so one of the purported pros of the income interest only method is that it's stable. Well, no, it's not. The interest rates change. Now, they don't change day to day. You don't see the EKG type graph that you see on the stock market, but they do change, and interest rates go up a little bit, and then they come down a little bit. And if that's what you're living on, that means your income is going to change as you reinvest those bonds when they mature. Anytime you're doing a interest only, you're most likely doing a laddered bond portfolio, which has varying maturities, so that when not all of it comes due at one time, and then gets reinvested at, unfortunately, a low interest rate environment like we saw for years, until just a couple of years ago. So one of the big problems is we can't earn enough with it. So most people, they can get 4% in treasuries right now. We're in the 4 to 4.5% world with treasuries. We could ladder out a 30-year bond and stay in the 4% world. You think the way it sits right now. But if I'm taking 4% out, that doesn't leave any room for inflation. Mm-hmm. It doesn't I'm going to be taking that same number. When they talk about the stable, well, that's the stable part. It doesn't go up. You don't get the inflation bump or anything, and you've got no chance of growing faster and helping you offset years where we have that 8.7% inflation like we had a couple of years back, where the bond rates didn't go to 8.7%, but inflation did. Mm-hmm. Our spending went up, and that's the problem with inflation. When the inflation happens and spending goes up, and then inflation goes down and interest rates come down, spending doesn't come down. It's still at that higher rate. And so we've got to figure out a way to be able to deal with that.
Yeah. This living off of the interest only, you mentioned this is kind of the grandparents when they went through the Depression and all that stuff. And I remember my grandmother telling me that, and she was saying, we have a certain amount of money and we're just able to live off of, at the time, I think it was, 8 or 9% they were earning on this. And this was, 30, 40 years ago. And she says, I'm just taking, 4%
and if
out.
you can if you could ladder out a bond portfolio earning 8 or 9% right now and live on 4%, you're probably okay.
Yeah. And that was,
it's just tough to do.
That was their methodology. And so the problem with that, while there's no sequence of returns risk and you've got protection of principal and all that, there's no room for inflation, and you may not make as much as you need.
And I will say there's no short-term sequence of return risk, not the way we look at it when we're taking money out on a monthly basis. But there's long-term sequence of return risk, because when those bonds ultimately mature, you're reinvesting at the then rate. So if we started a 30-year portfolio in 1985 and we put all 30-year bonds together, we were making 12% on our bonds, and they all matured in, what was that, 2015? 15? And we went from earning 14% to earning 2%.
Oh, that in 2015, you're right, yeah.
That was a big cut in pay. Okay, it was 30 years later, and maybe I'm not even alive anymore. But so the sequence of return risk isn't a month-to-month, hurting ourselves by selling when something is down, but the reinvestment risk is still there.
Yeah, so that's not a good way to go. While some people
not in today's world.
No, it isn't, and it's just a bit too unpredictable. So the other one, the next one, and this one and the following one, the next two are fairly similar. I'm going to call this one you take a percentage of your portfolio distribution. Professor Plum, you can say it better than I can, but explain what I'm talking about when we say this.
Well, everything's dealing with, once interest rates started coming down, people realized they needed to have some growth in their portfolio. And so they switched from an all income type portfolio and reinvesting the excess interest to a balanced portfolio that had the ability to get that 5, 6, 7, 8% rate of return while we're only spending 4. And so it was a matter of, let's use a balanced portfolio. And this is what the 4% rule, Mr. Benjamin, Dr. Benjamin, actually wrote about, putting together the 4% rule and using a balanced portfolio, rebalancing it every year. And how much money can we take out? On average, the balanced portfolio does X percent, which is more than what you're spending. So you've got room for some inflation adjustment as time goes along. But it doesn't help with the sequence of return risk. And there's a problem with that. So what they did was they said that there's 2 ways to play with this game. You take a balanced portfolio and you start with a certain percentage. You set the percentage that you're going to take based on the initial value. We'll do the proverbial $1 million because the math is easy. And we're going to start with a 4% distribution. We're going to continue to take that $40,000. 4% of $1 million is $40,000. We're going to continue to take that $40,000 out every year and increase it with inflation as time goes along. Increase it with the CPI. This is basically what the 4% Dr. Benjamin's rules were all about. And then we have a balanced portfolio. We're going to take a distribution from that portfolio pro rata, and then every year rebalance to the appropriate balance. So if one side goes up, one side goes down, we're just going to rebalance it and always stay in balance. Who wouldn't want to stay in balance? Mr. Miyagi taught this to us years ago. We need to have balance. And so it works for some things. It doesn't always work for everything, and it doesn't always work for finance. The problem is we are human, and we tend to do things on an emotional basis as well. So when interest rates go down, not interest rates, when the market goes down, maybe we're taking our 4%. We start with $1 million, and maybe we started in 2021 with that $1 million, the end of 2021. We took our 4% out. Now we've got $960,000 invested, and then the market went down. Even a balanced portfolio went down 10, 15%. So we're down to about $810,000 now, but we're still taking 4% of the original value. We're still taking $40,000 out. That's much higher than 4%. Now we're taking a bigger distribution, which has less likelihood of success over the rest of my lifetime.
Yeah.
And so we have to be able to account for these types of things. So what some people said, well, let's take that rule and throw it out the window. Let's start with a set percentage rate. And instead of CPI adjustment, inflation adjustment, we will adjust to the market every year. And so we will take 4% out and we'll redo the 4% every year based on the ending year value. So my $1 million starts off at 4%, or I take my 40,000 out, drops to 960. It grows back to 960. It actually grows back to $1.1 million. I had a 14% year, because I earned 10% plus the 4 I took out.
This is a hypothetical situation, by the way.
This is all hypothetical.
Yeah.
This is way out there.
We're just making this out.
So now the next year, I've got $1.1 million. I can take $44,000 out. 4% of $1.1 million is $44,000. So I gave myself a 4% or 10% raise, and so we're doing really well. But then along comes a year like 2008. 2000, 2001, 2002, 2022, 2018. Pick a negative year. There's a number of them to pick from. And my $1.1 million at the end of the year is now only $800,000, or it's $900,000. Now I've got to go from $44,000 a year to $36,000 a year. I have to take a cut in pay. That is not a fun way to deal with a budget. That's a difficult way to live your retirement life. You don't know whether you can go see the grandkids until the year's done, so you can see what your budget is for travel the next year. You don't know if you can, do the things in retirement that you thought you wanted to do, because the market wasn't behaving the way you needed it to behave. And the market in the short run is not your friend. It will do things against you. So we have to find ways to counteract this problematic year-to-year issue, whether it's taking a set percent for the beginning or taking a set percent every year.
Yeah.
They have their problems.
Yeah. Now, what we've done, this is kind of combining the two, and I want to make sure people understand what it is that you're saying here. In the first instance, you said, let's say we have $1 million, okay, and we're going to take 4% of that million, and we need $40,000. We need to make sure we have $40,000 a year plus, I guess, inflation every single year. So your $1 million, you're taking your $40,000 out. Maybe you have a good year, but let's say you have a bad year and your $1 million is now worth $800,000. You're taking out $40,000 out of an $800,000 portfolio, which is really not a good idea.
Well, it's a 5% distribution, which is 5% is a higher distribution, less likely to last the 29, 30 years left in your life.
Well, yeah, because now you're 800,000. You take out the 40, you're now down to 700. Whatever, 60,000.
It's harder to recover. So
it is, and you could potentially, at that point, Professor Plum, using that method. I mean, you could run out of money. I would hope you would adjust if your funds get too low, but that could actually run you out of money, right?
Right, and so this method works really well if your initial few years, in as many as 5 to 10 years, are positive. Every year is positive. And so it has worked. I'm not saying it doesn't work. It has worked very well. And can you tell me for a fact, though, that if you're retiring today, that the next 5 years are all going to be positive? The next 10 years, there won't be a negative year there.
No.
It has happened. And if that happens, this type of plan works wonderfully because you end up with more money than you ever thought you'd have before. But the market doesn't always work that way. We have these negative years from time to time. And when we have a couple of negative years, we've gone through the examples many times, and the difference between retiring in 1969 versus 1979, the difference between retiring, at different times, it is this type of distribution strategy is very, very dependent on the sequence of returns that you receive, that the world receives in the next 5 to 10 years. If you can go 10 years with no downturn, man, you're probably going to sit, pretty happy in, all the ways you say it. But if you have and they don't even have to be, huge downturns like 2007, 8, like 2000 to 2002. They don't have to be, huge drops like that. A couple in a row, you get like we saw in the 70s, a -5, a -4, a -7, not even double digits. And it decimated the portfolio of this type of planning over the 20-year time frame.
Yeah, so if you need that and you're taking the same amount out regardless of what your portfolio balance is, you could, unless you do something and change your method, you're going to run out of money. You could very well run out of money if you have a bad sequence early on. And
so you have to worry about running out of money or changing your distribution strategy to take less out, meaning you have less money to spend.
Right, and which goes to the other method that you mentioned a moment ago, which is, well, let's just take, let's call it a 4% out of whatever the
stated rate,
whatever the end of last year's, let's say, balance was. So if my $1 million the following year is down to 800,000, well, I'm not going to take 40,000 out. I'm going to take, what is that, 30? What's the 4%? Whatever.
Less.
It's going to be less. So you take a cut and pay. Now, doing that, obviously, you're not going to run out of money, taking money out of it because you're only taking a certain percentage of what's left. Kind of like what RMDs do, I suppose. But
RMDs do grow over time, but at no point do the RMDs for a retirement account equal 100% of what's there.
No, and it's always a percentage of whatever the previous year's balance was. So you could do that particular. But again, you are running the risk of not having enough money to live off of.
Right. There's no certainty in your spending. And we want to have, and most people, and especially in the early years of retirement, most people want to have more money, not less money, from year to year. And so that's a big blow to your retirement game.
Yeah.
If all of a sudden you realize, I got to take a cut and pay.
So you've got sequence of return risks in these. So those are the three that the interest only and percentages, those are the types of withdrawal methods that are, I think, out there and were very, very popular for a long, long time. And,
well, they still are very popular.
Well, they are, but I would say that ever since 2008 and considering the downturns that we've had, the occasional downturns that we've had since then, ever since that time, people have turned to the method that we, of course, like, which has to do with the bucket strategy. Now, I want to have you talk for a moment, Professor Plum, about how the bucket strategy addresses the cons of each one of those previous methods that we mentioned. Specifically, not having enough money based on interest rates, not having enough money, to live on to begin with, or running out of money and sequence of returns.
Well, nothing is foolproof, and we haven't seen what we haven't seen in the future. We don't know what's going to happen. So, but what we have seen in the past, we know what has happened and how things have worked. And one of the problems with the most popular, while buckets is catching on and becoming more popular, it is still not the most prevalent withdrawal strategy out there. The balanced approach, systematic withdrawal, with either the initial percentage setting or resetting the dollar amount every year. That balanced systematic withdrawal approach is still the most common. One of the reasons it's the most common is it's very easy. It is, of course, totally easy. But it carries that sequence of returns risk. And sequence of returns is something that we have absolutely no control over. What happens this year, next year, the following year, in the market, we don't know, and we have no way of controlling how it's going to happen. So we want to have enough cash flow for a long enough period of time to avoid ever having to sell something when the market's down. The problem with the systematic withdrawal is that we have to sell things at times to raise the capital to pay out our distribution from assets that are in a negative position. And if you sell an asset that's in a negative position, it can never recover. And so, if I can never recover, I'm just digging a bigger hole for myself. So we want to have enough safe money distribution. So what we do is we segment out the times. We want to have enough safe money that the markets do not affect to give us our cash flow for a specific period of time. This is where one of the debates on buckets comes in. How long is a sufficient time horizon for this? In our world, we look at bucket number 1 being 6 or 7 years. And we want to, because one of the more popular writers out there talks about having 2 years of safe money. And then the rest of the money in bucket 2 and bucket number 3. Bucket number 2 is more of a balanced portfolio. Bucket number 3 is a long-term growth portfolio. The problem with that is that if you look at historical numbers, the average downturn is about 18 months. So the market goes down for about 18 months. Well, if I've got 2 years worth of cash flow,
not enough.
If I had 40, if I wanted 40,000 a year and I put 80,000 in CDs in cash, I've basically bought enough time to get me too close to the bottom. And now I have to sell something to give myself some income, and I'm selling when it's down. So we want to have more than just a 2-3 year period of time. We want to have some safety and stability. So we typically use a 6 or 7 year time horizon for bucket number 1. So if I wanted that 40,000 a year to spend every year, and I'm ignoring inflation for a moment, but we can add this into it if you want. I want to put $240,000, $280,000 in bucket number 1 so that I know I can take a distribution of $40,000 a year every year, come heck or high water, with not worrying about the market's doing, not worrying about anything else. I know I got that $40,000 distribution for the next 7 years. If I have 280, that's 7 years. Now, 7 years from now, I'm going to have to do something. That's where we look at bucket number 2. And so we put money in bucket number 2 to be able to replace bucket number 1. Just for easy math, I'm going to use another $280,000. But I don't need $280,000 today. I need it 7 years from now. So I can get away with putting something less in bucket number 2 than the 280 that I need. But we're not accounting for inflation, but let's just put the 280 in there because it's going to grow over a 7 year period of time. We can get, now this is where you could use structured notes. You could use lots of different things. Because we have 7 years or so before we need the money, I don't need immediate liquidity. I don't need rock solid guarantee. I need good quality, even a good quality. This is where a balanced portfolio works really well. Balanced portfolios typically do 6 or 7%, give or take. And there's almost no 7-year periods of time where they went down. Even in 2008, the average balance portfolio went down 25%. But after 7 years, it was back, or after 6 more years, it was back plus to even plus. So it made some money. And so we're trying to take away the sequence of return. We put in a balanced portfolio there. We replenish bucket number 1, and off to the race we go for another 7 or 8 years. So what we've done, though, is we just spent $560,000 of that proverbial $1 million portfolio. We've only got $440,000 left. So we put $440,000 into long-term growth, right? But bucket number 1 lasted for 7 years. Bucket number 2 lasted for 7 years. So we've bought ourselves 14 years in this hypothetical example, and we put this, the 440 in the stock market. 14 years. Average of the stock market, let's just make easy math. Let's say it averages 10%. I said easy math because the rule of 72 works really well here.
It sure does.
So I start with 440 at 10%. The market's that portfolio is going to double in 7 years. So we go up to 880, and then over the next 7 years it doubles again, and we end up with $1,760,000. Assuming it did a 10% on average for those 14 years. So I started with $1 million. I took out my $40,000. I took it inflation adjusted because I was able to earn something on bucket number 2 over that period of time. Mm-hmm. And 14 years later, I've got $1,700,000.
And you can start all over.
$1,800,000.
And you can start the sequence, the process over if that's the way you do it.
And what we would look at doing is, refilling when it's advantageous. Yeah. Because one of the things I know about bucket number 3 is even if we think it's going to do 10%, and even if it actually does do 10% on average over those 14 years, it's not doing it each year. It's up 20% one year, down 10% the next year. It's all over the map. By understanding what we talked about last week, setting expectations on your portfolio, value averaging, and saying, you know what, I thought I was going to do 10, and this year I did 28, 29. Maybe I'll take a little bit of that off the top and put it back into bucket number 1, buying a longer term time horizon. Now I've helped myself out, and I've been able to make myself more efficient, less emotional. We have a very stable income. We have predictable outcomes because we've given ourselves time to be able to do it. We're not subject to the sequence of returns. We're not doing reverse dollar cost averaging. We're trying to control the things that we can control, and we're trying to let the things in the market that help us, time, volatility, do their thing in the areas where it can do its thing.
Yes, and what I guess if you want to say, well, there's a cost to everything. I mean, I guess what you're potentially giving up by only putting in your million, you have $1 million, you're only going to put 440,000 in your example into stocks. What you're giving up is the potential return or the amount of money that you could have had if you stuck 700,000 in there.
Oh yeah, if you put a lot more in there, you could have a significantly higher ending value 14 years from now.
So you're giving
or you could be broke.
Well, you could. So you're giving that up for the
safety and for the security, for the stability, and for the idea that the ending outcome is much more predictable. I mean, even if we put 440 in, and you only earned 8% over that 14 years, you still ended up with $1,300,000. You started with $1 million, you end up with $1,300,000. That's only at 8%. So you're still better off. So even if you didn't have the greatest 14-year period of time, you had a little bit less than average 14-year period of time. It's still, but with the other approach, your outcome, the expected ending result could be significantly higher, or significantly lower. That's bad.
Yeah, and I don't know too many retirees who would really like to take that risk, which is why it always surprises me that the more common way to do it is the one that includes a lot of sequence of returns risk. And as you said, it's because it's easier.
It's very easy, and it's just so easy. Now, to get that $1 million in this hypothetical example, to get my initial $1 million, where I put 560 into bucket 1 and 2, my 440 left over for growth. To get that 440 to grow to $1 million over 14 years, I need a 6% average rate of return over 14 years. that is not out of the question.
Historically, it's doable.
It's very doable.
Yeah.
Is it guaranteed? No. Nothing in the future is guaranteed. The question is, do you want to have a very volatile ending value or a more stable, predictable ending value?
Yeah, and I think most people who are retired would go for the more stable, predictable. We don't have a ton of time left, Professor Plum, but I think what you've talked about here shows why we address what all the potential problems are of the other types of withdrawal methods. I think with the bucket strategy, what we're looking at is setting the amount of money that you need to live off of and working toward getting that money no matter what the stock market does. No matter, the stocks go down 30%, your income is protected because it's
your cash flow is still the same cash flow.
Exactly. The cash flow is the same cash flow. And when it comes right down to it, that's what people want, I believe. And I don't think I'm going out on a limb by saying that. You really tend to care a whole lot less about what's happening in stocks if you know that, hey, at least I got my income coming in. Right?
That's the primary concern.
Yeah, generally.
Primary concern is to make sure I have my income. And hey, if I can leave something to the kids or to the whoever I'm leaving, that's good too. But primary concern is my cash flow.
Exactly. And now what you've done is presented a very basic, sort of elementary.
Oh, very basic.
This is not generally done, set it and forget it. This is a yearly sort of, let's review, see where we can value average, let's see where we can add some. I mean, so there's a lot of tweaking going on. But I think it gets the concept across. At least
well, the nice thing also in the interest only one was you pretty much had to live on whatever the interest was. What if you need more money than that proverbial 4 or 5% in the early years because you still have a mortgage, but then once you pay the mortgage off, you can drop your distribution a lot in the future years. With a bucket strategy, you can account for that. With one of the other strategies, it's much more difficult to account for that type of spending.
It sure is, and that's why we espouse the bucket strategy. I had to get the word espouse in. I think that was my word of the day. So that's why we talk about, and that's why, Professor Plum, you use the bucket strategy so often, and you use it to, I believe, a good advantage potentially. If you want to know more about this stuff, you want to talk to Professor Rick Plum or any of the Lucia Capital Group advisors, this is wheelhouse for them. Especially for you, Professor Plum. This is batting practice meat, as baseball players would tell you. This is a pitch for you guys thrown right down the middle. You've seen it before, and I believe you know how to work it. 800-644-1150, the number at Lucia Capital Group. 800-644-1150. Give them a call. Talk to them about this. You may have seen bucket strategies out there. You've read about them, but talk to them about the bucket strategy. It takes more work on the part of the advisors, but this is why they're trained to do this. And this is why Professor Plum has been doing this now for more than 30 years, right?
Yep.
Yeah, more than 30 years. I'm going to leave it at that. We were talking about how much older we're getting this year, and
not bad for a 39-year-old.
Pretty good. 800-644-1150. Also, make sure you subscribe to this podcast, Managing Your Financial Future. Download every episode to your device, whatever your device happens to be, and listen every single week. I think you get something out of it. Got a lot of we have so many different types of topics, and you can also listen to past episodes, most of which are, laws change from time to time, but I think the strategy portion of it really stays the same. So Apple Podcasts and Spotify. Also download our guides. We do have those: Social Security guide, retirement income guide. We have a bucket strategy guide. We got an estate planning guide, maybe a few other things. You can write to us there and email us as well. Go to luciacap.com, LUCIACAP.com, luciacap.com. That's where you find all this stuff. And you can find videos and white papers, blog posts, a whole bunch of stuff right there at luciacap.com. Professor Plum, I threw you a softball today with all these retirement income strategies, but hey, you deserve it,
Thank you, sir.
We could have gone another half hour, but we're not going to do that because we are out of time. I appreciate you being here, folks, and tune in again next time. For Professor Rick Plum, Certified Financial Planner Professional, I'm your podcast host, Johnny Dean. This is Managing Your Financial Future. We will, as always, talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice. It is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. A value averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Structured notes are considered complex investment products. They contain unique features, risks, terms, conditions, fees, charges, and expenses. Product suitability must be independently determined for each individual investor. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.